But let's talk takeovers, shall we? A bit of an M&A Monday. Harry Watt from Shaw Partners from Market Matters is joining us now. I mean, yeah, Harry, nice to see you, like the mother of all M&A activity happening in Europe right now. Interesting, because Credit Suisse, I mean, we knew that the bank was in trouble. Shares were down about 90% since their high. So it almost feels as if this is, a long, train wreck coming to fruition here.
Good morning, Nadine. It certainly is. It's a very interesting deal. It's actually probably not that big in terms of the scheme of the dollar amount that UBS are probably likely to pay for this Credit Suisse deal, but it's massive in terms of what it means for financial markets globally. We really need to see stability coming back into financial markets. It's really changed in the last just only 3 weeks, really, that everyone was sort of happy and rosy. Banks were earning a lot of money, and then this Silicon Valley issue came in, and you've had another couple of banks fall over. But this Credit Suisse deal is probably the biggest, the most meaningful in the space at the moment. Credit Suisse, if you think, the last 5-10 years of their history, it's been pretty poorly managed, if I'm honest. UBS have had their own regulatory issues and they had their own, stock-specific issues, but Credit Suisse, in particular, has been poorly managed. But then when you put it in the context of what this means for financial markets, this is a massive global bank that's out there, and it's really only going for $3 billion. So that's US dollars there. So it's interesting to see how this will play out. UBS were reluctant to come to the table here, but they were sort of forced in terms of government broking this deal to them. But in reality, I think that's a good thing for UBS. If you've got government support, you've got regulatory support, you've got support from central banks at the moment that are injecting liquidity into this financial space, I think they're going to pick up a pretty decent asset that's been poorly managed. And they can turn this around reasonably well in the next few years if they continue to have this regulatory support, which I think they will do. I think this must be, a cornerstone of this deal, is that regulators are going to come to the table and say, look, we're going to give you a bit of a free rein here. You go for your life, UBS. This is an opportunity for you to turn around a big ship with a lot of support globally in terms of what this means for financial markets and financial stability. So I think this is a good one. Like you've mentioned, the US futures have rallied on this one. We've bounced a little bit out of where our futures were before the market's liking this deal. I think there is still a bit to play out in terms of what it looks like over the next few weeks, of what it looks like for markets. But perhaps, hopefully, if you want to take the bullish stance that this may be, passing through of this financial issue that we've had, it might be just a short, sharp issue. If the market can, get a handle on this deal and really accept that, Credit Suisse and UBS tie-up is positive going forward.
All right, keeping an eye on that one. Obviously now, when it comes to some local M&A, obviously not on the scale of Credit Suisse UBS. However, Australian Clinical Labs, ACL, making a play for Helios. Is this opportunistic?
I definitely think it's opportunistic. It's an all-scrip deal that they've come to the table with here, ACL. It's actually really interesting to see a smaller company going after a larger company. Australian Clinical Labs, their market cap's around about 700 million, whereas Helios is sort of the $1.6 billion range. So, they're coming to the table with a very interesting deal. ACL has very low gearing, whereas Helios is a reasonably well-geared company. So there's an opportunity there for ACL to take on a little bit more gearing, take on a little bit more risk, and see some growth out of that. I think the deal makes a lot of sense. I just think it's come to the table in a very interesting manner. So ACL, there's going to be a lot of synergies. They've actually flagged EBIT synergies of $95 million. When you put that in context, Helios is really only expected to make 100 million EBIT. So that's a massive number in terms of upside in synergies there. If you look through to what they're talking about in FY25, they're talking about EBIT of $320 million. So almost a third of that comes from synergies, which is massive in the grand scheme of things. It's massive in terms of getting value out of this transaction. I think they're probably going to have to amend those numbers a little bit. I don't think there's enough premium in there for Helios at the moment, but I do think it'll make both these companies think about what their future looks like, and I think they will come together with a more acceptable deal for both parties in that respect, Nadine.
Okay, well, look, Harry, it's all live. Are you guys there keeping an eye on any other potential, takeover targets, given all of the uncertainty that we have out there, given the fact that we've got a lot of Aussie companies really struggling as we see interest rates rise?
Yeah, definitely. M&A's actually been okay. It's sort of been ticking over, the last few years, even as interest rates have risen. But I think in this market, it's now presented an opportunity for companies that have, really compelling stories in the M&A space to come to the market, to have their large shareholders backing them, to make these M&A deals work. We know there's a lot of cash on the sidelines still. So these big investment banks, these big fund managers are out there, they're all cashed up. So they want to see a compelling story that makes sense to put more of that money to work. I think in that Helios and ACL deal, there's another one in this healthcare space that should really be a target. Capital Health, that's trading at a pretty deep discount to where it should in our view. And I think that there's a lot of synergies that are able to be extracted. They had a crack at IDX a few years ago, and I think that one, they may come back to the table with something there to try and extract more value out. And a very similar manner to the ACL and Helios deal, there's a lot of revenue synergies, there's a lot of cost synergies out there for these two companies to come together and create a compelling story for fund managers to really have a look at and put some of that money to work. We have a look at the gold space. That's one that's been really interesting. We've had Newcrest, big company, get bid for by Newmont. Didn't think that deal was worth it the first time around. I do think that there is more to hear about this story. Newcrest has got a great suite of assets. Newmont have come to the market and said that they want to grow, and they're happy to do that through M&A. I think that there will be a number that Newcrest can agree on to get that deal done. Whether Newmont can get there, whether this gold price rally has made it maybe a little bit too expensive, I don't know, but I think that there's more to play out in that story. And if you have a look at the smaller gold stocks as well, Genesis has been very, very vocal in terms of trying to build out their Leonora assets in WA. And what that looks like, they've gone after St Barbara. They want St Barbara to do a little bit of M&A within themselves first before they can get their Leonora asset combined with Genesis. But I think that is just highlighting that there is money on the table and that there are some compelling stories to come to market. And when there is money cashed up sitting on the sidelines, stocks will want to get a handle on that and will want to see some value out of that, and they'll have to come to market with a very compelling story, of which I think there are plenty out there at the moment, Dean.